Yeah, so welcome to today's Wednesday live session. We are going to look at the two trades we have taken this week, see how the trades are doing, and if there's any need for adjustments, we do. If there's no need for adjustments, leave them and let them roll. First one is CAD JPY. Okay, I don't need to do the analysis again. I've done it before, but there is a YouTube video right now specifically on CAD JPY. Theoretically, CAD JPY is due for this move. The worst that can happen is that CAD JPY will make this small move here. It's a supply, and it comes down. After CAD JPY must make this move. It is based on theory, not based on my own proposition. It must make that move, and then it must come down, make this structure upside. This is a structure. This is a non-structure, guys. All right. I've told you in that YouTube video, this is A, B, and C, small letter. This is capital letter A, capital letter B, capital letter C. And this forms a complete corrective structure for the upside. All right. For you to know all these ones I'm doing, you must study Elliott wave theory. Okay. When you understand Elliott wave theory, you will be able to get what we are trying to do here. Good. But we are not in Elliott wave theory class, but that's just the focus. Now, I've told you this leg and this leg are equal. So for that reason, no point for this market to come downside. Moreover, if you take your feet to know the level of retracement between here and here, this is already below 61.8. So it's cool for us. That's why the reason why it has to go below 0.618 is because this structure, this leg here, must be proportional to this leg here. Right? Call it equal legs. So if it stopped at 0.618 here, this leg will be shorter than this one, and this structure will not therefore make sense. So for the structure to make sense, equal leg must take preeminence over 61.8% field retracement here. This equal leg must take preeminence. Okay, so when you are doing your analysis, you should know which structure should take preeminence, which theory you should prioritize over the other. Okay, so that is a cardinal. We are still biased to the upside, but unfortunately, this week market has been extremely slow. Market has been extremely slow, almost remaining in the same position. But at the end of the day, this move is highly favored. Okay, that is a CAD JPY. Now, the main thing I want to focus on today is to discuss with you why interest rate is so important. You know, why is interest rate so important over and above GDP, over and above inflation? Okay, over and above inflation, over and above, let's say, consumer, producer price index, PPI, and consumer price index, CPI. Of course, you know, CPI is used to measure inflation. CPI is used to measure inflation. So the inflation data that we get depends on what we get from CPI, right? So now, why do you see me going to check inflation rates of different currency when I want to decide whether to buy it or to sell it. And why don't I just go and check GDP? Why don't I go and check the inflation? Why don't I go and check CPI, PPI, and all those things? The reason is simple. This GDP figure you see here is not determined. This inflation you see here is not determined. It happens. We now measure it. This GDP here, it happens. We measure it. This CPI here, it happens. We measure it. This PPI here, producer price index, it happens. We measure it. Even housing data, it happens. We measure it. But you know what? The relationship between all these fundamental data that happens and we measure them, they are being controlled with one single factor, one single, stuff, which we call interest rate. We look at this GDP figure, we look at this inflation figure, we look at PPI, CPI, housing, deficit, everything, we look at them, relate everything together. We relate everything together, and then we now use inflation rate. We now use this inflation rate to control the economy. All right? For instance, if the growth of the economy is too high, all right, the GDP is going higher and higher. The economy is growing at 6%. What does it tell you? It means that the manufacturing sector is doing well. Almost every sectors are doing fantastically well. You risk having inflation in such economy. All right, you risk inflation in such economy, but this kind of inflation is a positive one because your economy is growing. That's why there's inflation, right? There will be employment because the higher the GDP, the higher the employment and the lower the unemployment, all right? And the higher the inflation, all right? So as if GDP is increasing, inflation is increasing, you need to control this inflation with what? Interest rate. Can you see? Now, assuming the economy is doing badly, is doing very bad, all right? Consumption is very low, income is very low, unemployment is too high, the economy is not doing well. And what we need to do in that case is we want to probably try to increase consumption, because it is when people are consuming what the producers are producing. When they are consuming it, that is where there will be a need for replacement of inventory, all right? The more you are buying stuffs, the more the warehouses, will be empty, and the more the manufacturers will need to produce to replace what have been consumed. So in that case, industry will be working fine, industry will need more staff, unemployment will drop. But you can see the rally point here is consumption. And for there to be this consumption, okay, you must create an enabling environment for the companies, the industry to produce, for there to be increase in consumption. And what do you do to prepare them for a better environment, a better productive environment? What do you need to do? You have to still bring in the instrumentality of what? Interest rate. How do you do it? You look at them. Oh, these companies, they need to produce more. What do I do to them? Let me drop interest rate for them. When you drop your interest rate for them, then you have just succeeded in reducing cost of borrowing. So when cost of borrowing goes down, all right, when cost of borrowing goes down, the effect is that they are able to produce, at a more competitive price compared to their peer, compared to their foreign competitors. They're able to produce at a better price. They will sell at a better price, and people will even consume more. Why would they consume more? Why would people consume more? People will consume more because, because they are able to, borrow money at a low interest rate. There's low interest rates. They're not keeping money in the bank because the interest rate is low. Just as the interest rate is low for, the manufacturers, and they are able to borrow money at a cheaper rate, and produce for the consumer to consume. The same way, consumer will increase their consumption, will increase their expenditure by borrowing from the bank. They're not only borrowing from the bank to buy, consumables, no, but they also borrow from the bank to invest in real estate. Okay, if interest rate is very low and they can get their fund at a cheaper rate, what happens? Investment will go up. They will go and buy houses. They will go and buy shares. They will go to capital market. It will boom. Do you get now? So you can now see that when you are talking of GDP, inflation, you talk of interest rates to control it. Can you see? Talk of GDP, inflation, you need interest rates to control it. You talk of, we are talking of high GDP here. If you are talking of low GDP, economy is not doing well at all, or probably economy is in recession, all right? Recession is a scenario where you have three or four consecutive quarters of, of reduction in your GDP or negative growth, all right? You are now growing. Instead of growing, you are coming down. You are coming down for 3 consecutive quarters. You are coming down fast, negative growth. That is what? A recession. So when there is recession, what we have to do is to create an environment that will increase this consumption that you are seeing. Because we know that if consumption is increased, then producer can produce. And when they are producing, everybody will be gainfully employed. And then the recession, will jump over it. And then to create that environment, for investment to thrive, you need interest rates. Can you see? In every fundamental we are mentioning and we are explaining, we are requiring interest rates to do one adjustment or the other. Do you get it now? So you talk of PPI, producer price index, consumer price index, all these measures inflation. This CPI measures inflation. And when the CPI, the measure inflation, when this inflation is very high, you need something to arrest it. What is that thing? Interest rate. When inflation is high, it means that there is general increase in the there's increase in the general price level, okay, of goods and services. So when that happens, we call it inflation. And when such thing happens, what the monetary authority, people in charge of monetary policy, what they just do is to make use of what? Interest rate. Can you see? How do they use interest rate? Okay, they make sure they increase this interest rate so that when this interest rate is increased, what happened to the available money supply to the economy? Money supply to the economy will drop. Why will it drop? People would prefer to go and keep their money in the bank. All right. Why? Because interest rate has been increased. Okay. And then as interest rate is increased, what happened to investment? Investment will drop, guys. Investment will drop. Why? If you increase interest rate, you are increasing cost of borrowing for investors and business people. You are increasing cost of borrowing. So when you increase cost of borrowing, they are not going to come to borrow money from you, and they are not going to be able to buy machinery. They are not going to be able to finance business expansion. They are not able to, buy the real estate. They are not able to build that 60-story hotel. They are not able to, plan that road infrastructure within a road network within the company. Can you see? So when you increase interest rates, investment will go down. Consumption will go down. Why will consumption go down? People that are spending money before, they can no longer waste their money because there is a promise of increased rates of interest. So they rather go back to the bank, deposit their money, and earn interest. That is going to reduce consumption. Going to reduce consumption on the part of the consumer, and it's going to reduce consumption on the part of the producer. So can you see? So this interest rate is key. So I don't bother to, get the idea of the gross domestic product of any country. I don't try to get the idea of inflation. I don't want to get the idea of some of those other fundamentals, crude oil inventory and all sorts of fundamental. I don't care to get them. Okay, what I care about is simple. I want to see the inflation rate in that country. I want to see the inflation rate. That's simple. Because if I have access to the not inflation rate, sorry, interest rate, I want to know the interest rate, because if I know the interest rate, the interest rate now and the interest rate before, I can tell you with a measure of authority whether the country is growing, the GDP is growing, or the inflation is increasing or not. Why? If I don't have access to inflation figure, but I do know that interest rate was increased from 0.5 to 1, I will know that since interest rate is increased, it means that there was inflation. It means that the inflation of that country has increased. And so because of that, you have to use the instrument of interest rate to reduce it by increasing interest rate and mop up excess supply of money in circulation. Can you see? So without being privy to the inflation record, I know what is happening just by knowing what interest rate is talking about. So now you need to understand. Now you understand why interest rate is so key, is so important. Now what you need to understand next is how is interest rate related to currencies. All right. How is interest rate related to currency? You need to know this. Now, look at it this way. Let's look at it this way. For instance, if, let's say, USD, let's use example of USD. Interest rate was increased from 0.5 to what? To 1%. Okay, because inflation is biting very hard in US, as a result of, supply gap of commodity like oil, natural gas. You understand? So now, look at this, guys. Interest rate has been increased from 0.5 to 1%. How does it affect USD? I want to ask you a question. If your deposit, you were earning 0.5% on your deposit before, and right now you are being promised that if you deposit US dollar, you're no longer going to earn 0.5%, but you're going to earn 1%. What are you going to do as an investor? Are you going to sell the US dollar that you have, or you are going to keep it? Are you going to sell or keep? You keep or sell. Because before the rate was 0.5 and now the rate is 1%, meaning that any deposits or any USD that you have, you are going to collect a higher rate, a higher return on them. Of course, you are going to keep it. You are not only going to keep the one you have, you are going to do what? You are going to buy more. You are going to demand for more USD. So the question is that if you are demanding for a particular product, if many people are demanding for a particular product, what happened to the price of that product? Everybody want to buy. Everybody want to buy. I'm looking for it. You are looking for it. Mr. J is looking for it. Mr. S is looking for it. Everybody is looking for it. What happened to the price? Price is going to go up because you are going to create environment of excess demand over what? Over supply. Excess demand over supply. This is the situation we are going to create. And whenever there is excess demand over supply, price is going to go up. This is the reason why increasing interest rates of any country, you should envisage the value of that currency to go up. Can you see now? Okay. Now, haven't understood this perfectly. You now want to check with our example of card CHF, for instance, card CHF. We are going to use this as a case study today. In your spare time, you can also check other currencies, pair them together, and then do the same analysis as I'm doing now. Okay, so what are you supposed to do? You need to go to Google. You can Google it. Very simple. Just say interest rate on card. Interest rate on card. Okay. Interest rate on card. Let's look at it here. Interest rate on card. Previous 1%. Actual. This is actual. This is April 1%. Actual has not been released for this one, so we're expecting it on June 1st. That's when we're expecting the new rate. But you can see a progression in the figure. You have 0.25 here. They increase it to in March. They increase it to 0.5. In April, they increase it to 1%. Then another one is coming in June. I can bet it with you. It's not going to be less than 1%. Okay. Instead of it to be less than 1%, it's going to remain the same. But I still believe it might be like 1.25. Okay. So can you see the figure now for card? Let's go for CHF, guys. Let's put CHF here. Interest rate on CHF. Can you see? This is 2016. No, what is 2022? OC16. We are not there yet. Okay. 2022 OC 03. The last one that was released previous was minus 0.75. They have not released a new one. All right. Switzerland interest rate 2022. Let's check the forecast. Okay. Can you see the last one that was released was what? Zero actual. This is what you check. Actual, guys. Minus 0.75. Do you now see the difference in the rate between CHF and what? And what do we call it? And card. Card has interest rate of what, guys? Of 1%, and then CHF has interest rate of minus 0.75%. That means that, I don't know, some of you might not be able to analyze this. Let me tell you how to do it. Can you see? This is 0. All right. This is the interest rate on card. Okay. This is 1 here. This is 1 here. This is 0.5 here. Okay. This is minus 0.5 here. And this is minus 1 here. So minus 0.75 is between here. That's half of this and this. So from 1 to this one this is 1, this is 1.5, 1.75, guys. 1.75. That is the difference. %. That is the difference between the interest rate on card and that of CHF. So because of this differential, you now, after you have understood it like this, you now see, you now look at it this way, that because this one has, because card has a higher interest rate than CHF, it then means that fundamentally you believe that card will appreciate against the CHF. Now you have established this fact. After establishing this fact, what you need to do next is to go to your chart and go and look for buy opportunity. Go and do top-down analysis and do, after you have done your top-down analysis, you now find out how card JPY or card CHF will touch support on a bigger time frame. So let's go to card CHF right now. Card CHF. Where is card CHF? Card CHF here. Okay, are you getting it, guys? Okay, so let me clear up this. Let's go to daily time frame. Can you see daily time frame? It has been bullish, responding to the rate decision. Can you see it has been creating flag for you? Going, correction, going, correction, going. Now, this leg, although it look overextended, but nevertheless, let's see what it's doing on smaller time frame, like 4 hours. Guys, there's still possibility of this structure. We might lose the trade that I give. Why do I say we might lose the trade? Because right now, this is the demand level that this pair is cleaner for it to be bought. Because after this break of structure, this is structure. After this break, the market has come back to where? 61.8. Can you see here? 61.8 has tested it and it's going. Okay. So now, if we have to look at it critically, this leg, if we take it here, it's not up to 61.8. It's not up to 61.8, guys. I see it's not up to 61.8. That is why I'm saying the possibility of it coming down to this area is there. All right. If it does come back to this area, no problem. That will be a lost trade. Then we look for opportunity here. Why are we looking for buy opportunity? Because based on our fundamental, card CHF is bullish. We don't want to sell it at the moment. Okay. So another thing that can happen is simple. If this does not go, I still believe this should go because I decided on this buy on smaller time frame. Can you see this time frame? Okay, this time frame. All right, this time frame. So look at it, very clean and clear. This is a flag, and this flag is bigger. And since this market started moving from here, we have not had a cleaner flag, you know, apart from this. This is a very clean flag. And again, another reason why I think we should get it is simple. You see that I'm looking at this as a corrective structure, A, B, C, A, B, C, 3-wave corrective structure. So I already see this as a move. Can you see this as a powerful bullish, you know, structure to the upside? Cool. You see it? Powerful bullish rally to the upside. And then after, you now have 3-week corrective structure. 1, 2, 3. Okay, the same way this one corrected 1, 2, 3. And we expect it to move. That's the same way this one corrected 1, 2, and 3. So after 1, 2, and 3, what do we expect? Boom. So based on the structure before me, the least that can happen to CAD yen, even if it has to come down to test that low that I told you, CAD yen structurally must come to this top. Structurally must come to this top and create what is called a regular flat. When you start fundamentals of Elliott wave theory, you will know what is called a 3-wave corrective structure. Are you okay now? So by what we are seeing before us, already we have secured a very fantastic engulfing candle here. So by virtue of this engulfing candle that has closed, I expect that this market should proceed to the upside, minimally to 76.70. When it gets to 76.70, we will check whether it's going to make another leg down before we buy, or if it does not go, if it does not go to make another leg down, then it will be making corrective structure here. Pull down and then we go. Are you getting it, guys? It's going to make another corrective structure here, then up we go. So either of the two, we are up to the task to read the market the way it is. So, but minimally, we're expected to get to the top here. After that, if it's going to make another low, fine, let it come down. And when it's coming down, what are you expecting? Let me show you what you have to expect. Go to 4 hours, guys. Go to 4 hours. You see, that's what is called mean reversion. Mean reversion. Okay, mean reversion, just the process of a pair reversing to its average level. All right, see this move? See this move? It's reversing to its average level, mean reversion. See there? See this move? See this one here? Coming back to the what? Mean reversion, 50% mark. You see this move here? Coming back to where? Mean reversion. So demand here, coming back to this place. This will be a fantastic price level to buy CAD CHF to the upside. Do you get it now? If it does not go above 76, giving us about like 40 pips, fine. We take our profit, let it come down to the low, then we continue from there. But nevertheless, looking at it from 1 hour time frame, I do expect that this structure should go this way, should go this way. I still believe it should go this way. I'm more favored for this this move to the upside because of that big differential in the interest rate of CAD and CHF. Okay, so I told you that I'm looking forward for CAD, Euro CAD to come down, and then Euro New Zealand and Euro GBP, all Euro, expecting some of them to come down. Why? If you go and check the interest rate on Euro is 0. Just say interest rate of Euro. Can you see fixed rate tender? Fixed rate. What do you see here? No, this year is back, way back 2016, 16 March 29. No. Let's check this one. I think the rate is 0 right now. Okay. Let's get the interest rates on Euro. Can't get it here, but the interest rate is 0. All right, it's 0. All right, The interest rate on euro overnight deposit, okay, is 0. Interest rate effect, got it. This 2022. All right, just do your research, guys. But I don't know that interest rate on euro is 0. So if interest rate on euro is 0, then and that of card is 1. So what does it tell you? It means card, let's say euro card. By the analysis I've done for you, if card is 1 and euro is 0, then card is what we want to buy. And then euro is what we want to sell because the interest rate is lower than card. So if that is the case, we'll be looking for sell opportunity in what? In euro card. And then when it was down here, I told you we're expecting it to move to the upside. Why we did not catch the whole of this move is that I was looking for inducement, boom, like this, but I didn't take into cognizance my 61.8 here. This market is already at 61.8, guys. It's already at 61.8. Look at it from here to here. Boom. Okay. So because we are already at 61.8 here, I should have expected that any move here will lead to the upside. This is supposed to be our trade, guys. As soon as we got this move that broke this top and pull back, this pullback, grabbing liquidity. All right, as I grab it, create engulfing here, this was supposed to be our trade, guys. But we miss it because we're expecting this low to be taken. Wanted to be more careful. Let this low be taken up, correction up. This is what we were expecting. That was why we missed the whole peak. But that's not a problem, guys. Remember, almost 2 weeks I've been telling you this move will come. Right now, we are looking for sell opportunity. So what I'm looking at right now is possibility of having this structure. Okay, can even still go up, come down, correction, boom. This is what I'm waiting for, guys. That's why I've not tried to, to sell this pair. I don't want to sell this pair right now because I'm looking for this possibility. I'm looking for this corrective structure. I'm looking for why am I looking for a break here? If you look at this thing, guys, look at it from here to here. Was the top broken? No, the top is not broken. So you have to think very smart. You have to think like a bank. You don't have to think like a retail trader. This is resistance. All right, watch out. Resistance, resistance, resistance. How is the retail trader looking at this place? Resistance. What would they do? Sir, I want to ask you a question. If bank have pumped in volume here to sell this pair, is it still going to be coming down correctively? No, it's going to have moved down. Boom, 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 like this. Why is it not moving like that? Because the people that are pumping order here are the retail trader, not the bank. And we have to trade like the bank. We don't have to reason like a retail trader. For that reason, what we are expecting is a correction here, pull up to the upside to break all this top and then catch it at this supply area here. Can you see, guys, that there was a clean sell here, between here and here, clean sell above this resistance. Prolong it, project it rather to the other side. Determine psychological level, most likely 1.3800, 1.3800. That is a very ideal side where we expect this market to grab liquidity. If we can grab liquidity here, I will get in without wasting time. I'll catch it here. See, the market will take me down. Boom, break this low. As soon as it break this low here, it's going to correct. Boom, again, correct. Boom, again. But you have caught it here. This is how to reason like the bank. We also have Euro GBP. Euro GBP, you know, can you see I've already marked it there? This is what I'm looking for. And if this does not happen, guys, I'm not going to get in. What do I say? If this does not happen, I'm not going to get in. I want to see clear and clean liquidity graph, because if this pair is expected to sell from here to the downside, then you expect orders from liquidity providers. You expect big order to come in, and big order cannot come in except the big banks come in. And how does the big bank come in? They give you consolidation here, and then boom, break this top. You know, as soon as it's breaking this top, all the people putting buy stop here, they will move it down. It will hit their stop loss. All the people putting sell limit here, what happened? Market will break to the top, hit their stop loss. You have to reason smartly, guys. So this is a ideal way that market develop in order to move, you know, greatly to the downside. Let me give you an example of what I'm telling you, and there we'll wrap it up. See, so you see this, guys. See this corrective structure. You see this consolidation close to this resistance. You see what happened here? Market grab, boom. You will be saying this is resistance, sell here. No, boom, it has broken it. As soon as it broke it, what do you see? Boom, correction, boom, correction, boom. Can you see this move to the downside here can never be accomplished by a retail trader. It was accomplished by the bank. But before they accomplish it, look at how they work it. Let me show you another example. You have another example? Yes, sure. What is it? Consolidation. What is this? Claim buy. Okay. What is this? Resistance here. Resistance here. This claim buy is a fake out to clear this top, clear this top. After that, what do you see? Boom, to the downside. Retail trader cannot make this boom. Retail trader cannot make this upside. The people that make this boom to the downside are the same people that make the upside for you. Why? They cannot afford to sell here. They can't afford to sell here. They have to sell at the top. And if you go and check the top, guy, you're going to see psychological level or sub-psychological level there. That is where they place their order. What is this? 0.8650. That is the sub-psychological level where they place their order. So, guys, this is how this thing works. It's very simple. It's not complicated. Don't over trade. Can you see the whole of this week? How many trades have I taken? 2. And I've not lost any of them, and I'm still in them. Right? So if you don't over trade, you will definitely make it with the style of trading and the skill set I'm giving to all of you. All right. So I don't know if any of you have any question. You know, don't know if you have any question. Meanwhile, I'm going to upload this video to YouTube. Some of you, when you access my video on YouTube, you just subscribe, you watch the video, but you don't comment. If you don't comment on the video, YouTube is not going to show it to other people to benefit from it. And then as a result, when they are searching content like this, they're not going to discover us. So you need to, make a comment. Even if it's to say, I like your video, or if it's to say, I don't like your video, no problem. Whatever you feel about the video, let your, opinion be heard there. And then most times, you people come and you come and tell me, ask me questions, this and that. When you watch my video, comment there and tell me what you don't understand there. And tell me what you want me to, explain, or the video you want me to do for you. It's an opportunity for you to get access to me. Those that are not in my Telegram group, they will have access to the video and have access to me by chatting with me on the comment box. That's how it works, guys. So don't just watch the video and go. You have to subscribe, you have to share, and you have to what? You subscribe, you share, you comment. Those are things you can do to help the channel to to grow. And I encourage you to do it. Thank you very much, and God bless you.